In 1980, one Zimbabwean dollar was worth more than a US dollar. Today, that same US dollar is worth trillions of them, and the paper they are printed on is worth more as trash than as actual money. The millionaire illusion. Meet Silas. He is a world traveler, but he is also a pawn in a global, invisible game. In New York, Silas buys a coffee for $5. In Berlin, that exact same coffee costs him €4.60. But when he lands in Vietnam, he is suddenly a multi-millionaire. The teller at the airport hands him 125,000 dong in exchange for a single $5 bill. Why does this happen? Why isn't one unit of currency equal to another? And why do these numbers flicker and change every single second on every trading screen across the planet? To understand the chaos of the present, we have to look at the golden past. 1. The death of real money. For centuries, money was not just paper, it was a receipt for gold. This was the gold standard. If a government wanted to print a dollar, they were required to have a physical piece of gold to back it up in a vault. This system was stable, disciplined, and honest. However, governments often dislike discipline. By the 1970s, the world shifted to fiat money. Fiat is a Latin term meaning "let it be done." Money now has value simply because the government says it does. It is not backed by gold. It is backed by trust. Some critics call it fake money, but in reality, its value is determined by the most powerful force in the universe: supply and demand. The inflation trap. The first reason the money Silas carries fluctuates is inflation. Think of it as the dilution of a currency. If a government prints money faster than it creates actual value, each individual dollar buys less. Look at the history of Zimbabwe. Through corruption and reckless printing, they turned their currency into a global joke. At its peak, prices were doubling every 24 hours. They eventually gave up entirely and ditched their own money to use the US dollar just to survive. When trust dies, the currency dies with it. The interest rate magnet. Why is the global financial world obsessed with the Federal Reserve? It comes down to interest rates. Think of interest as the rent people pay to use money. When a country raises its interest rates, it offers a higher reward for holding its currency in their banks. Global investors rush to sell other currencies and buy that specific one to earn those high returns. When demand goes up, the value skyrockets. This is why when the US raises rates, the rest of the world's currencies often tremble. Stability and the petrodollar. Investors are like deer. They are easily spooked. They crave stability. If a country faces a revolution every month, nobody wants their money. But if a country is stable, like China was during its massive growth spurt, investors flood in. To build factories and pay workers, they must buy the local currency, the yuan. The US dollar has a special advantage here called the petrodollar. Because the world buys oil primarily in dollars, every nation on Earth must hold US currency to keep their lights on. This creates a permanent global demand that keeps the dollar at the top of the food chain. The fixed value strategy. Some countries decide they do not want to play the market game at all. They use a currency peg. Brunei, for example, pegs its currency 1-to-1 with the Singapore dollar. Belize pegs theirs 2-to-1 to the US dollar. It's simple and stable, but there's a catch. They lose their economic soul. If the US economy crashes, Belize crashes with it. They are passengers in a car they're not driving. The big question: why not one global currency? If exchange rates are such a headache, why don't we all just use one world dollar? The euro tried this, and it revealed a dark truth. When one country, like Greece, went into a financial tailspin, it dragged the entire continent down. Germany had to pay for the mistakes made in Greece because they shared the same wallet. A global currency would mean a crisis in one corner of the world becomes a catastrophe for everyone. Conclusion: the secret strategy. You might think every country wants a strong currency, but that's a mistake. A weak currency makes your exports cheaper for the rest of the world. China has been accused of keeping the yuan artificially low so that made in China remains the cheapest option on the shelf. Money is not just a tool for buying coffee, it's a weapon of economic warfare.